Now, step 5 then, is to know, what are the strategies and how do they work? So there are basically 5 different strategies that I'll look at that can capture, profits from extreme price volatility that's going to surround an earnings season. Now, each strategy, works best based on certain circumstances. So there are 5 different ones, and these are kind of the buckets that I look at and try to scan and look at picking stocks out and put them in these different types of buckets. So these are all basically non-directional earnings strategies, okay? These are strategies that would be used just for an earnings release, not going into, pre-earnings or post-earnings, just for an earnings release. So they're non-directional. We don't care if the market goes up or down or the stock does. These are going to be designed specifically for certain things we want to capture. Now here's the first one. This is what we call the short iron condor spread. So basically it's a debit spread, but this one is used and constructed for big price spikes. So there are going to be certain situations like AKAM where the probability suggests that the price is going to be a big potential spike up or down. And this is the way that we can take advantage of that. The next one is what we call the long iron condor spread. This is a very typical one used to take advantage of the volatility crush that we get after the earnings release. Remember, the earnings implied volatility is moving up, and then after the earnings release, all the uncertainty is out, boom, it just fizzles out like popping a balloon. Okay, so it takes advantage of that. The third one is also for volatility crush. This is what we call the iron butterfly, an additional strategy designed to take advantage of that volatility crush. The fourth one is a really cool, different dynamic strategy that I've put together called the double lightning. And it's basically a debit spread as well. So the total risk of this is your debit paid. But this one is really cool because this one takes advantage of both volatility crush plus any price post-trend movement after a trade. So certain stocks you might want to hang into it, after the announcement, and you don't want to get out that week, but maybe you want to get out another, hold it another week or 2 weeks out. So this is a way that we can do this trade with the double lightning or double calendar basically. And then the fourth or fifth one is what I've designed and put together, which is an earnings pair trade. So this is a long short strategy designed for post earnings trend that's specifically a spread between 2 stocks or stock in an ETF or post earnings trend that gets its catalyst from the earnings, okay? So this is a great way to play a pairs trade from the catalyst of a specific earnings and what that does to a specific stock versus another stock within its industry or peer, or versus a sector ETF that it's in. All right, so we'll go through all these